So, welcome to tax planning through different stages of your retirement. My name is Bill Tasker, and I work for Four Wealth Advisors here in Burr Ridge. And tax planning and taxes in general are pretty tricky. And we're going to go through some slides. There's about 20 of them. And hopefully, I don't get confused because what happens with taxes, oh, geez, I think there's 70,000 plus pages in the tax code. But a lot of taxes, when you compute them, you almost have to compute a sub piece to plug it into another piece to get your final outcome. So it's not as simple as it appears. And as we'll see, certain items can trigger other items that could cause big taxation. So you might have a dollar over a certain limit that could trigger huge Medicare taxes for Part B and D. And if you're just $1 short, it wouldn't trigger these taxes. It seems very onerous and very penalizing, and that's because it is. So we'll see that as we go through. So let's get going here. As always, there's always going to be a disclaimer, right? Seek professional tax guidance. You should always seek a qualified tax advisor to discuss your tax situation. Here over at Four Wealth, we have a whole tax side. We have a couple of great CPAs that can handle all kinds of complicated tax questions that you might have. All right, we're going to start in with how are taxes calculated? Well, in a nutshell, we're going to start with gross income. This includes wages, interest, dividends, IRA distributions, Social Security that's received. Then we have additional IRA contributions. Sorry, let's start with the top. Those are your top line numbers, your gross numbers. Then we have less some adjustments or some deductions, which are IRA contributions, HSAs, health savings accounts, self-employed health insurance, student loan interest, other adjusted gross income adjustments. That's going to give you your AGI or your adjusted gross income. So you've got your basic gross wages, then you've got your other above line adjustments. That gives you your AGI. Then you're going to subtract either the standard deduction, which is 15,000 for a single person, 30,000 for a married couple filing jointly, or itemized deductions, whichever is going to be higher of those two, not both. And the itemized deductions could include mortgage interest, state and federal, or sorry, state and local taxes, property taxes, charitable contributions, and medical expenses above a certain AGI threshold. That's going to give you your taxable income. Now, this taxable income is then going to be run through the tax brackets to calculate the income tax that's owed. And here are the tax brackets for 2025. It's all tiered. So you're going to have a marginal tax rate, which is the rate you're going to pay on the next dollar's worth of income. And then you're going to have an effective tax rate, which takes the weighted average of all the different blended tiers. So, I won't go through every line of them, but for the first basically $12,000 of income, you pay 10%. For the next, let's say 37,000, you're going to pay 12%. And then the next 50,000, you're basically going to pay 22%. So imagine if you had, $100,000 of taxable income. Roughly, if you say, okay, I'm paying 10% plus 22%, the average weight of that's about 16, 17%. So if you're just looking at federal income taxes on $100,000 of taxable income, your effective rate is about 17%. Your tax rate on the next dollar worth of income, if you're in that 48,000 to $103,000 bracket, you're going to be paying at 22%, but your effective rate is going to be less than that because you're paying some at 10% and some at 12%. Now let's take a look at Illinois versus federal tax rates for retirees. it's a little bit different. And let's go back a little bit. For most of the cases for Illinois taxes, if you're not retired, most of your Illinois taxes you're going to pay off of your adjusted gross income or your AGI. For federal taxes, I could give all my money away essentially to charity, and my itemized deductions. Let's assume that I made $100,000. I could itemize, deduct away, and give all my money to charity and basically pay nothing in federal taxes. But since my Illinois tax is based upon my adjusted gross income, I can't do that. So my Illinois tax, which is basically about 5%, I'm going to pay about $5,000 in taxes on my Illinois tax on that $100,000, even if I gave all that money away to charity, because they base it off of my adjusted gross income. So it's based on a different figure. But let's take a look at if I'm retired, which is going to be most of the situation for the purpose of this webinar. IRA distributions, federally taxable, yes. Illinois, it's exempt. Social Security, you're going to be taxed federally. Illinois does not tax Social Security. Same with pensions. Illinois does not tax pensions. So it's funny when people talk about how we have a high gas tax in Illinois, property taxes are high. That's true, but most of the pension and Social Security and IRA distributions, all your sources of retirement income are tax exempt. So it's not as bad as you might think. All right, let's take a look at Social Security and taxation. Social Security taxation under the new 2025 tax bill or the big beautiful bill. So what did they do here? Well, seniors get an additional $6,000 standard deduction. Pretty much you got to be 65 years old or higher, and you get an extra $6,000 deduction. So they didn't really eliminate Social Security like they said. Like you might have heard Trump say, no tax on tips, no tax on overtime, no tax on Social Security. It's not really the case, but they did lower taxation overall, and we'll give an example of that. And this is only good, per my understanding, until 2028. So it's only good for basically 3 more years anyway. So a lot of this stuff is, you got to kind of look at it for what it is. But hey, 3 years of lower taxes, I mean, I think anybody would take that. So up to 85% of your Social Security is taxable if your provisional income is greater than 35,000 for an individual and 44,000 for a married couple. So there we go again with these other terms, right? What is provisional income? That's adjusted gross income plus tax exempt interest plus 50% of your Social Security benefit. So let's take a look at an example here, a couple of calculations. So here's somebody that has IRA income of 30,000 and Social Security income of 20,000. So you might look and say, okay, they've got retirement income of $50,000. Well, how is this going to be calculated? Under the old bill and under the new bill, where you get your additional $6,000 exemption. So on the left-hand side, I'm sorry, deduction. Your standard deduction is an additional $6,000. So under the old bill, you got a $15,000 deduction. So our provisional income is going to be our $30,000 plus 50% of our Social Security, which is going to be 20,000. So half of that is going to be 20,000 or 30,000 plus 10,000, which is 40,000 times 85%, which is going to be 17,000. So $17,000 or 85% of our 20,000 of Social Security is going to be taxable. So now our taxable income is going to be 30,000, which is our IRA distribution, plus our 17,000, which is the amount of Social Security that's taxable, less our standard deduction, which is 32,000. So kind of earlier when I was mentioning how you have to figure out one piece and plug it into the other. Well, here we go. Now let's take a look at on the right-hand side with that additional senior deduction of $6,000, what happens? Now, the provisional income doesn't change because that calculation is the same. It's 30,000 plus the half of the Social Security. That comes out exactly the same. Nothing changes with the provisional income. But now instead of deducting the 15,000, we're deducting 21,000. So now our taxable income is no longer 32,000, it's 26,000. So what is the effect? The additional $6,000 senior deduction, it lowers our taxable income by $6,000, which is going to lower our federal tax owed. So the key takeaway on the bottom here, the $6,000 senior deduction reduces total taxable income and federal taxes, but it does not change the percentage of Social Security that is taxable. So the idea, no tax on Social Security, no, not really, because if they eliminated the tax on Social Security down to zero, everybody would basically be, in a 10 to 12% tax bracket. There'd be no federal taxation. The federal tax revenue would go down probably by a third. I mean, the federal government would be at that point, well, we're already insolvent. It would really be insolvent. So let's take a look at the tax calculation on the next page, given this. This gets a little bit tricky. But going back up here, we're going to take a look at our scenario of a single filer, $30,000 of IRA income, $20,000 of Social Security income. We have our tax brackets up here. So we're going to look at our standard deduction and our senior deduction. So the taxable income is $32,000, and there's our tax bracket calculation. So our total federal tax on the left-hand side is $3,620, but on the right-hand side, since our taxable income is less, it's only going to be $2,900. So the effect of that reduction is going to be we're saving $720. So basically, if you think about it, since we're going to be in the 12% bracket, we're going to lower our taxable income by $6,000. $6,000 times 12% is $720. So all we're basically doing is saying, hey, we're getting a bigger deduction. That's going to lower our taxable income. It's going to lower the size of our tax liability by that same amount. If you're married, filing jointly, that could be $12,000. You would double that amount to $1,440. Okay, Medicare and taxes. Now we've got something called the Income Related Monthly Adjustment Amount, or IRMA. So you want to watch out for the Medicare IRMA cliff. It's the extra amount you pay each month for Medicare Part B and D premiums if your income exceeds certain thresholds. Basically, you don't pay when you start taking Medicare, you don't pay for Part A, which is the hospital portion of Medicare. You pay for Part B and D. B is for doctor visits, D is for the drug portion. But if you go over $1 over an IRMA threshold on your Parts B and D premium, and your Parts B and D premiums jump to the next tier, potentially costing hundreds, if not thousands more per year. So unlike the effective tax rate on your federal bill, IRMA is a cliff. So if I'm just $1 over a threshold, I'm going to get nailed. I mean, they just sock it to you. And we'll take a look at this real quick here on the next slide. So here's our 2025 Medicare IRMA adjustments. Now, fortunately, the cutoff point is pretty high. So they only really hit you if you're making a lot of money. So let's take a look at the first tier. And I won't go into all the details because it's based upon your modified adjusted gross income, and it has a 2-year look back. So it gets even more confusing and complicated than you think. But for a joint and a single, let's just take a look at the joint. Let's assume that everyone on here is married and we're going to look at the joint range. So for people that are making 212,000 to 266,000, in that group, your standard Part B premium is $185 a person. For Part D, it's basically nothing. You don't really pay anything. However, if you're $1 over that 2012 threshold, if you make 2012 and $1, you're going to pay an additional $74 a person and 1370 for a person for your drug portion of Medicare. So you're looking at what? About $90 times two, let's say 200, you're almost it's about $2,300 a year more. So if you had one stock sale, let's say, or one extra dollar worth of your required minimum distribution that you could have avoided because you did a prior Roth IRA conversion, that could trip a next IRMA tier, which could cost you $2,300, if not more, as you go up the line here. So you got to be very careful about tripping that, just that one extra dollar. Medicare enrollments, coverage gaps, and late penalties. This to me even seems more crazy because you pay in to the system your entire life, and then if you forget to apply at the right time, you pay a penalty. So let's take a look at Jim and Ann. Jim retired at 65 and Ann 1 year later at 66. They get covered or get coverage through Ann's employer who offers retiree health insurance. When should they enroll in Medicare Part B? That almost sounds like a two-part trick question. Well, pretty much because it is. Well, they want to enroll in Part B, or should they enroll in Part B as soon as they retire? Well, kind of, yes and no. There's a, if you miss an enrollment, they're going to charge you 10% off the base premium for life. They won't do that for Part A, but for Part B, if you don't enroll in time, they're going to hit you with a 10% penalty. And let's say if you don't do it for the second year, now it's a 20%. And I think it just keeps going on and on and on, where they just keep hammering you. Now, I don't know if I have the exact numbers here, but for the most part, once you turn 65, there's about a 7-month window. I believe 3 months prior to the month you turn 65 and 3 months after, where you have to enroll in Medicare for the Part B. Otherwise, they're going to hit you with this 10% penalty. Why they do this, I really don't know. I mean, that's a question that I'd have to, do a little delving in, or anybody that's listening could do. But, you really want to make sure that you apply when you should. Now, if you're with a company that I believe has 20 or more employees and they're offering you, if you're over 65 and you're still getting health coverage from that company, you don't have to apply for Medicare Part B. So there are some exceptions if you're still employed with a larger company. But if you're with a company that's 20 employees or less, I think, then you got to apply for Part B. So the whole point of this is I'd be really on my toes if I was turning 65 to make sure that I'm applying for Medicare Part B at the right time. All right, two other retirement pre-strategies if you qualify, and there's always going to be income limits, but you should always try to use a health savings account or an HSA because you get a tax deductibility, which will lower your adjusted gross income, which is one of the ways you can lower your federal taxes and your Illinois state taxes. Because remember, Illinois taxes are based upon your AGI. So you get a tax deductibility, kind of like an IRA. It has tax-free growth and has tax-free withdrawals. There's about a $5,300 individual limit. And I think the family limit's around $8,600. There's also, if you have a business, you want to use the QBI, the Qualified Business Income Deduction. You can deduct up to 20% of your business income. You can take that as a deduction. And they wanted to do that, I believe, as a when they lowered the corporate tax rate down from 35% to 21, they wanted to give S corporations another way to lower their tax rates as well. Okay, charitable giving and tax planning. All right, so we have Albert and Shirley. They're in the 24% bracket. They want to give 5,000 to charity. They've got 15,000 in existing itemized deductions, but their standard deduction in 2025 with the additional 12,000 and their step up, because they're seniors and whatnot, it's $46,700. So if they give 5,000 to charity, it's not going to help them because, you know, the standard deduction envelops that $20,000 of itemized deductions. So it's not going to, there's no federal tax benefit. However, there's a way around this. They can do what's called a QCD, a qualified charitable deduction. You can do that if you're over 70 and a half. So up to $100,000 from an IRA per person. It has to go directly to a charity. It counts as an RMD, but doesn't get reported as income. So instead of taking your required minimum distribution for 5,000, that 5,000 goes right to a charity, and you don't have to report it on your income tax. You don't get an additional deduction for it, but you don't have to claim it on your taxes. So let's take a look at an example here. So option one, charity gets the 5,000. The 5,000 satisfies the RMD. The 5,000 is reported as taxable income, but the tax bill on the distribution that equals $1,200. Total cost of the taxable contribution is $6,200. So in this way, you're basically taking the RMD, paying the tax dollars, and then you're going to give the charity the $5,000. However, the other way, now we're going to say the charity gets the $5,000. $5,000 satisfies the RMD, but now the $5,000 is excluded from taxable income because we're using the QCD contribution. So now your tax bill on the distribution equals zero. So now the total cost of the charitable contribution is only $5,000, not $6,200, because we're not paying the $1,200 on the taxes from the RMD because we exercise that QCD contribution. So it's a good little way of giving money to charity using your RMD that you have to take. And, it's a way that when your itemized deductions are small, it's a great little tool depending upon your situation. All right, organize your assets for your family's benefit. Estate planning still matters. Let's take a look at a step up in basis strategy. The step up in basis pretty much means that when you pass away, if you have a highly appreciated asset where your market value is higher than the cost basis, when you pass away, the person who's the beneficiary gets a step up in basis, so they no longer have to pay any tax gain on that. They don't have to pay the taxes because now the market value, the cost basis moves up to the market value, where there's going to be no tax consequence. So let's take a look at this. The rule treats a beneficiary as if they purchased the inherited asset on the day it was left to them. Future gain or loss is based upon the asset price on that day. So we got Phil and Mary. They hold a taxable investment in a joint brokerage account. So it's a joint tenant with rights of survivorship. So the account has a capital gain of $120,000. Phil is diagnosed with a terminal illness. He's got 18 months to live. Scenario one, do nothing after the diagnosis. So remember, it's a 50-50 joint account. So Phil dies and Mary inherits Phil's half of the joint account. The step up in basis eliminates the long-term gains on Phil's $60,000. So if Mary sells all the investments, she'd only owe income tax on her $60,000 of gains. So the bottom line is Mary owes tax on her 60 grand because she gets up that step up in basis on Phil's assets upon her death. But is there a better way of doing this? So scenario two, after the diagnosis, what if they moved all the investments into one account in Phil's name? Phil dies 18 months later. Mary inherits Phil's entire account, and all the assets get stepped up in basis. Now Mary can sell and she pays zero in taxes. I mean, that seems to be a better way, right? So these little steps you can take can save you a lot in taxes. Doesn't do Phil any good, but it helps her out a lot, right? So inheriting IRAs, there's some choices here. It used to be with inherited IRAs, you used to be able to call, there's a concept called a stretch IRA, where somebody would pass away, you can give it to a younger beneficiary. They could take it out over their 30, 40, 50 years of their remaining life and maybe take out 1 to 2% a year. But they eliminated that to where now you have to take out your inherited IRA over 10 years unless it's a spousal IRA, then it becomes their IRA. But we're going to assume here it's a non-spousal IRA because the federal government wants their tax dollars, so they want to, collect their tax dollars within 10 years. Hence another reason why you want to consider rolling over IRAs into a Roth IRA. Well, I'm sorry, even then it's a bad example because an inherited Roth IRA is still that doesn't really apply. It does and doesn't. You still have to take it out within 10 years with a Roth conversion, but let's put that aside for now. Let's just stay on point here with Pamela. So Pamela's 65 years old. Son Kyle's 40 years old. Pamela dies and leaves 100% of the IRA to son Kyle. There's a $400,000 balance. Let's say there's a 6% average rate of return. Scenario one, Kyle takes distributions over 10 years to minimize tax. Kyle was listed as a sole beneficiary. He has 10 years to take all the required minimum distributions and empty the account. It is 6% average rate of return and a $400,000 balance. His annual distributions are about $54,000 a year. Scenario two, he does nothing and takes the full distribution in year 10. He has 10 years to take out all the required minimum distributions and empty the account, but he decided to wait until year 10 to take the full distribution at a 6% rate of return. In year 10, now he's going to take out $716,000. So now he's going to be, whatever he's going to be taking out here, it's most likely going to be at the highest marginal rate tier or one of the highest tiers for him. Otherwise, that he could have, stretched it out over those 10 years and tried to minimize that rate of return. Plus, if he would have taken it out over 10 years, not only would he had minimized his taxes, he could have reinvested it going forward, and so the numbers may have come out even better. Okay, well, that pretty much wraps it up. And if you have any questions, you can always contact us. Our number and our website are in the bottom left. Address is on the right, but I would always say if you have any questions on any tax planning and any investments, give us a call. We're always here to help answer any questions, especially how tax planning and investment planning and estate planning, how everything coordinates. And it all has a fit and a rhyme and reason. And hope to hear from everybody soon. And stay tuned for our next webinar coming next year. Thank you very much. Take care.